Welcome students. So now we are in the process of preparation of the balance sheet, and in the balance sheet we have completed the first source of funding of this company, that is capital. We have taken the total authorized capital, and out of that we have shown that the company has used, out of the total 11 lakhs, company has used the 4 lakhs, and then we have some additions in the capital, appreciation in the capital has been made, that is by reserves 40,400 and by profit for the current as well as for the previous year. The total profit has now been transferred to the balance sheet, that is 47,607. So it means share capital is over. If you say that, if you total it up, this share capital becomes somewhere 4,88,000, almost 88,000. So 4 lakh was initially invested, and 88,000 is the appreciation in the capital, which was because of the profitability of the firm. So when the firm has earned the profits, they have been transferred to the balance sheet, and now the funds available with the firm are 4,88,000, that is the appreciation of 88,000. So it means we have completed the capital part. Now we will be looking for the other sources this firm is using, and after that we will be completing the process of the balance sheet, by balancing it. So now we take the other sources, and the other sources, if you look at here, the other sources are premises is the asset, plant and machinery is asset, opening inventory, debtors, cash in hand, cash, current account, bills receivable are assets, purchases, preliminary expenses are assets, wages, general expenses, salaries, bad debts. We have taken interest on term loan is the revenue expense, share capital, equity and preference we have already dealt with, and now the secured loans. So now we have the next item is secured loans. Secured loans, and the secured loans are here, that is 4,50,000 rupees. No loan has been repaid, so we have the total balance of the 4,50,000 rupees secured loans are here, 4,50,000 rupees of the secured loan, and there is no other source of funding this company is using. This company is using only two long term sources, one is the share capital and second is the term loan, that is a secured loan of the 4,50,000. Now after this we will have to go for the short term sources. So we write here current liabilities and provisions. Current liabilities and provisions. So now the current liabilities are, if you look at the current liabilities, so the current liabilities are, first part, that is A part is the current liabilities, this firm is using current liabilities. So the current liabilities are, what are the current liabilities? Let us see now here. You will find in the credit balances all the liabilities here, we will find here. So we have the equity capital done, preference capital done, secured loan done, profit and loss balance adjusted, bills payable is the one, this is the one, bills payable, this is the one current liability, bills payable are say 55,500. So let us check, is there anything say to be added here, or something is given in the additional information, depreciation, preliminary expenses, interest, bills receivable, doubtful debts, value of inventory, and there is nothing else. So we have done this. Then we have creditors. Next liability, next source of liability is, next source of funding here is creditors. They are sundry creditors or creditors. So the creditors are 83,000. Creditors are 83,000. We have taken the creditors also, sales, general reserve. So I think these are the two current liabilities, and third liability is, that is the central sales tax. Yes, that is the central sales tax, which is not yet paid. This is payable. Central sales tax is payable. So this is 10,800. Central sales tax is 10,800. And another liability is interest on interest on term loan. Interest on term loan, we had shown the interest for 54,000. It means if you look at the total interest here, that is on the 4,50,000 at the rate of 12%, the interest works out as 54,000. Out of that 27,000 has been paid and 27,000 is yet to be paid, but we have shown in the profit and loss account the total 54,000. That is the one effect is over. Second effect we are doing here, interest on the term loan, and that is which is outstanding. Outstanding interest on term loans is 27,000. We have to take here, we have taken, and then I think almost all the current liabilities are over. We have considered all the current liabilities. These are creditors, bills payable, sent to sale tax and interest on the term loans. And now we have to come down to the provisions. B part of this is provisions. So provisions we are making for what? We are making two provisions. One, we are making the provision for the dividend, and then second is making the provision for income tax. So this is the income tax. First provision is income tax, which we have shown there, but now we have to show it as a liability until unless it is paid. 30,763 was the tax part, and dividend component is proposed dividend, we would say it is a proposed dividend. So proposed dividend is 46,000 here, and I think there is no other provision. So it means we have already completed the assets liability side, capital and liability side of the balance sheet, and then we will be moving forward to the asset side of the balance sheet. Here it is one important question, that why we have shown the income tax and the dividend as a liability. See, when we have subtracted this tax and dividend, tax was subtracted from the net profit in the profit and loss account, and we have debited the profit and loss account with the tax amount, and dividend was shown, proposed dividend was shown in the profit and loss appropriation account. So there when you make a provision, means in the profit and loss account and profit and loss appropriation account, we are only making provisions that yes, we have to pay the income tax. So we have now kept this much money means separate, set aside. Similarly, we are going to pay the dividend 46,000. So we are going to set aside certain sum of money. Now after the date of balance sheet, means the last date of the year, the income tax will be transferred to the government account. After that, maybe in the new year, that is maybe within a month, or means as early as possible, it should be transferred to the government account. So it remains as a provision here till the time it is paid to the government, means it is a liability on the company for the period, that is when it is subtracted or the provision is made in the profit and loss account until it is paid to the government. It remains a liability on the company, and till that time these funds are used by the firm. So they become the source of fund also, and until unless this tax is paid to the government, this remains a liability on the head of the company. Similarly, when we talk about the dividend is also taken out from the profit, and we have made the provision in the profit and loss appropriation account for paying the dividend, but there only it is a provision that taking out the money, but that money has not been transferred to the shareholders yet. And as per rule of the as per the Indian Companies Act, the dividend amount after the declaration of the dividend, that is on the date of balance sheet, last date of the accounting period, it can be passed on to the shareholders up to 90 days or within a period of 3 months. It has to be sent to the shareholders within a period of 3 months, means 90 days. So companies normally use this money for almost 2 months and 3 weeks, and they start dispatching the checks, or the total dividend is transferred to the shareholders account in the last week of the 3rd month. So till then, means making the provision in the profit and loss appropriation account, until then it is transferred to the shareholders account. It is used by the companies as a source of fund, and that is why it is, but it does not belong to the company, it belongs to the shareholder. For the time being they are using it, finally it has to be transferred to the shareholders. So till then it is shown as a liability in the balance sheet. Once it will be paid, tax will be paid to the government, and then the dividend will be paid to the shareholders, then these two items, these two provisions will be removed from the balance sheet. So in the current year's balance sheet we are showing, and next year for example if there is no tax to be paid and if there is no dividend to be paid by the company, then these provisions will not exist. But because tax has to be paid every year and dividend also companies pay almost every year, so these provisions exist in the balance sheet of the next year also will exist, but the figures will change. Then figures will come for the New Year's tax and the New Year's dividend. So till the time it is paid to the government and transferred to the shareholders account, it is used by the company, it is a source of fund for the company, and consequently the liabilities, but short term liabilities, very short term liabilities, only up to 3 months. Now let us move to the asset side of the balance sheet and put up all the assets here. So when we talk about the asset side of the balance sheet, we have to take all the assets, and first asset is the we have the land. Land here is, land amount is 87,500. 87,500. Then we have the premises. Premises is the kind of buildings. So premises is 3,60,800. 3,60,800. I am putting it in the inner column, and we have to charge the depreciation also on these assets, fixed term assets. So less depreciation, and depreciation was how much? That is 10%. So it is 36,080 rupees is the depreciation. So it means we have 3,24,000 is the balance, 3,24,720 is the balance in the premises account. Then we have the next asset is the plant and machinery. Plant and machinery. Plant and machinery is here. So plant and machinery's balance is 4,95,000, and I guess the depreciation is also here on this amount, less depreciation. So the depreciation is how much? We have charged the depreciation on this plant and machinery at the rate of 14%, and that was 69,300. So the balance left here is, how much balance is left? That is 4,25,000, and it is 700. 4,25,000 and 700 of the balance in the plant and machinery account is there. So I think these are the three fixed assets. Let us check again. We have land, we have taken, premises we have taken, plant and machinery we have taken, then opening inventory, then cash, then receivables, purchase, preliminary expenses, then share capital, loans, then profit and loss account, all this. Yes, there is no other long term or the fixed asset with the firms. These were the only three fixed assets. Land was for 87,500, premises for 3,60,800 less depreciation. So final balance left at the end of the current year is 3,24,720, and then we have the plant and machinery, that is 4,95,000 and depreciation subtracting it. So we are left with 4,25,700. So these are the three long term assets. Now let us come to the other assets which are called as current assets. So these are the fixed assets, and now we talk about the current assets. So the current assets are, here are the current assets. So when we talk about the current assets here, we have to take the current assets, means what are the current assets here? Now let us start with the current assets here. Premises, plant, machinery, opening inventory. Yeah, first is the debtors. First is sundry debtors. Sundry debtors, and sundry debtors amount is how much? That is 106,050. 106,050 is the sundry debtors. Cash in hand, cash at bank will take later on. So it is given to us here that we have some bills were dishonored. Some bills were dishonored here. If you look at this information, we are given that bill receivable worth rupees 25,000 were dishonored and the effect was not carried out. So now the dishonored bills will be added in the sundry debtors, because these bills have become redundant, but they are the person who has to make the payment to this company, he is still the debtor to the company. So he have to add bills dishonored which is 25,000. So this amount works out as 50,013 1,31,050 1,31,050, and now we have to subtract the provisions. We have to make the provisions, and it is written here that we have made the provisions for make doubtful debts are to be provided for 3,000. So 3,000 amount will not come. So less provisions 3,000. So this final amount left with us is 1,28,050. This is the provisions amount 1,28,050. Next current asset is the bills receivable. Bills receivable. So what is the total amount of the bills receivable? If you look at the figure of the bills receivable here, the figure of the bills receivables is 58,875. 58,875, and out of that 25 worth of bills less bills dishonored, so that was 25,000. So that has to be subtracted from here. So we are left with the final amount of 33,875 worth of the bills are left now with the firm, which are expected to be collected or expected to be received by the firm at the some later date. So we have taken the bills also. Now what are the other current assets are left? Premises, plant, machinery, debtors, land, cash in hand, cash at bank, bills receivable, purchases, preliminary expenses, wages, general expenses, salaries, bad debt, interest, then it is bills receivable, bills payable almost. Now we will talk about the preliminary expenses. Preliminary expenses. So preliminary expenses are total is 7,500 less written off is 1,500. So we are left with how much? With the balance in the preliminary expenses account, we are left with 6,000 rupees worth of the preliminary expenses are left to be adjusted now. Now we talk about the cash in hand and cash at bank. So we have taken the yes, we have left one item. Yes, I think that is the inventory. We will be taking now the inventory also. Before cash, let us take the inventory or the closing stock. This is inventory, and the inventory was, it is given to us, that is the inventory amount is closing stock inventory. Closing inventory here given to us is the somewhere it is value of the inventory on 31st March 2016 is 135,000. So that is also a current asset. This is the inventory, and then we have to go for the cash. Cash in hand, and the cash in hand balance is, that is also given to us. Cash in hand balance is 4725, 4725, and then the current account. Current account balance is, balance in the current account is, that is 45,500, or you can say it is a cash at bank. It is the cash at bank 45,500. It is a cash at bank. So almost we have taken all the assets here. You took again want to verify. We have taken the inventory, we have taken the debtors and adjusted for the doubtful debts and bills dishonored. We have taken the bills receivable less dishonored, cash in hand we have taken, current account we have taken, and then we have taken the preliminary expenses, that is 6,000 worth of the preliminary expenses we have taken. This is a miscellaneous expenditure. So now this is the total of the asset side, this is the total of the liability side, and if we total up these two sides, we will be able to find out that the total of this side is we have taken the capital earlier and now the remaining. So if you total it up, the balance comes out as 11,91,070 is the total of this side, and certainly going to be the same total on the asset side also, and this is 11,91,070 is the total of the asset side. So total of the liabilities and asset side. So you see that if in this case if you look at what was the basic difference as compared to the two balance sheets. We have seen the balance sheet we prepared for the non-company form of organizations, and now we have prepared the balance sheet for the company form of organizations. So here the basic difference was that in the non-company form of organization no share capital was shown, but in this balance sheet we have carefully shown the considerably categorically shown the share capital. We started with the authorized capital, then we have shown that how much out of that is issued, subscribed, called up and the paid up capital, right. And then there is a main difference. Then we have gone for the secured loans, that is a long term source. So as I told you that in the sources of funding for the companies there are the three sources, that is long term finance, short term finance and the spontaneous finance. In this balance sheet if you look at, this firm has used only two sources of the finance, that is the long term finance and the spontaneous finance. No short term borrowings are used, no short term loans from the bank have been used. So up to this secured loans, capital and loans, they are the long term sources of the fundings. Capital is also the longest source and the loan is also the long term source, secured loans. And then the remaining are in the current liabilities. If you look at bills payable are the bills to be paid to the suppliers. Similarly, the payment to be made to the suppliers is again the creditor. So no finance is coming, rather material is coming. So spontaneously material is coming, spontaneously the payment is going out when it is becoming due. Similarly, the central sale tax, this is the liability because it has become due. This is the expense that has become due but not yet paid. So we have to consider that also. And then we have to go for the again interest on the term loan. Interest on the term loan is also the expense due but not yet paid, and that interest on the term loan was 54,000. Out of that 27,000 was paid as shown here, and 27,000 we have to take it as a liability, so we have taken it. And then we have to come down to the third item here, that is the provisions. First provision is for the income tax and the second provision is for the dividend. So as I explained to you earlier, income tax and dividend are shown as liabilities till the time they are transferred to the concerned stakeholders. Income tax will go to the government's account and the dividend will go to the shareholders. So till it is transferred to the shareholders and the government's account, it is shown as the liability. So this is the total of the liability side. So major difference in this balance sheet and the earlier balance sheets is that here we have the detailed information about the share capital, whereas in the other balance sheets no share capital information was there. And now you come to the asset side of the balance sheet. So in the asset side of the balance sheet there is not a major change. We have been considering almost all the assets earlier also. We have taken the land, we have taken the, here we are calling it premises. Premises means building. So buildings we are also been talking earlier. So we have taken the depreciation, means the principal amount and less depreciation, then plant and machinery and principal amount and depreciation. So these were the three long term assets: fixed assets which are land, buildings means premises, and plant and machinery. No furniture, no fittings, nothing. And now lower part talks about the current assets, short term assets. So current assets are like sundry debtors. So we have taken the, but there is one change that we have got the bills now here, bills receivable. As I discussed with you the difference between the sundry debtors and the bills. So it means some sales which were made against the bills receivables, means sales were made by the company to the person or to other company, and a bill was got received from that company, and on the due date when the bill was presented to this company refused to make the payment. They said that we will not make any payment, and they have denied making the payment. They have refused making the payment, so this bill had become dishonored. Dishonored means when on the due date, when the bill is presented by the selling company to the buying company and the buying company refuses to make the payment, that bill is considered as dishonored. So what will happen now, that out of the total bills, because this bill's date was only in this year, and when it was presented it was dishonored, so it becomes now the useless. So when it has become the useless, so it means now the bills balance is transferred, that dishonored part is transferred to the sundry debtors account, and sundry debtors, because that firm who has bought and refused to make the payment, though they have this bill has become redundant, but still that firm is a debtor to this firm, Mamta Fashions. So it means the balance of sundry debtors has gone up from 1,06,000 to 1,31,000, and the bill receivable has come down because that 25,000 part bill has become redundant. So we have subtracted 25,000 from here and we have added 25,000 rupees here. Then from the bills receivables, now that company remains the debtor. And then we have the subtracted the provision for doubtful debts as we have been doing in the past. Again, now bills receivables, the original amount minus the dishonored part, and then we have got the one more new thing here is, that is the preliminary expenses. As I told you that the preliminary expenses are the expenses incurred before the company comes into existence or the company starts business or company starts production. So these are the preliminary expenses. So these are the expenses which are sometimes very large, and if they are large, so it is not advisable to debit them in the first year's profit and loss account. So we have to capitalize it. So we treat it like an asset, we show it in the balance sheet, and in the balance sheet the total amount is shown in the balance sheet, and some fraction of that, part of that we keep on transferring to the profit and loss every year. So for example, in this case if you look at total preliminary expenses are 7,500. Out of that 1,500 of the worth of the preliminary expenses we are going to recover this year, we have transferred to profit and loss account, and now the balance in the preliminary expenses is left is 6,000. 1,500 will be recovered next year, 1,500 next year, 1,500 next year. So that way in the next 4 years that total amount of the means this year plus next 4 years the total amount of the 7,500 will be recovered, and this item will be removed from the balance sheet. After that we have the balance of the cash in hand, and current account means companies' accounts in the banks are called as current accounts. Companies are not allowed to open the savings account. Whatever their cash in the bank remains, that remains in the current account, and that is the current account means the account in which the company's account cash remains in the bank for day to day uses. For the current uses, that is in the current account, and that account is called as the cash at bank, means current account is the cash at bank. So what is the difference between the saving account and current account? In the saving account, when we deposit the money, we get the interest on that at the rate of 4% or something like that. But on the current account for the companies, no interest is paid by the bank. They keep the amount for day to day uses, and the number of transactions is also fixed in a day. So if any company increases the number of transactions, in that case the company has to pay to the bank rather than bank is paying any interest to the company. So that current account, so this is in a way, and companies are not allowed to have the saving account for their business transactions, for their day to day transactions. If they want to keep the cash in the bank, then it has to be there in the current account, and that is in a way we call it as the cash at bank. So cash in hand and cash at bank. So these are all liabilities, these are all assets, and this is the balance sheet of a company form of organization. And if you look at the difference, means the difference other than share capital and certain new items, there is no much difference, and we have to adjust for the share capital. Yeah, we have prepared the profit and loss appropriation account because we have to create the reserves, we have to pay the dividend and some other say provisions. So for that we have to prepare the profit and loss appropriation account. So we have prepared the trading and profit and loss account, profit and loss appropriation account, and the balance sheet for the company form of organizations. Similar one more, this kind of the problems we will discuss in the next part of discussion, and after that I will shift to the financial analysis, financial statements analysis part. Till now we have learned, means by doing one more problem we would be completing the learning of the preparation of the financial statements of all kind of the organizations, sole proprietors, partnership firms and company form of organizations, that is both public and private limited companies. And once we have completed the process of learning how to prepare the financial statements of all form of the business organizations, then the next part will be, we will start talking about the financial analysis, that if these three statements are available with us, on the basis of these three statements, how to analyze these financial statements and how to draw the meaningful conclusions, what are the different tools and techniques available, we will be discussing and we will start talking about after doing one more exercise in the next lecture or in the next part of discussion. Thank you very much.